This particular video, we're going to look at exercise 414 and 415. I want to talk to you first here in person a little bit about 14. As accounting authors, again, they love to get you to understand that the cash flow from sales and the revenue are really, in accounting, two different things. Very, very different things. But they're going to give you cash receipts amounts, and then they're going to give you some other numbers, and they're gonna say, well, calculate revenue, right? So let's look at this real closely here, what they're doing, and you'll see that revenues is 842, and it's clear here, but revenues minus expenses equals net income in a simple illustration of profit, net income, right? It is basically revenues minus expenses. And so they give you an expense amount, they give you the net income, and what you have to do is just kind of add these two together to, basically so add this one to this one to get the revenues. And see, if you'll see that the cash receipts amount is 780, so that has absolutely nothing to do with revenue. Remember that we record revenue whether we receive the money or we don't. So revenue, but if we earn it, we record it. So it's a little ticking point that they love to mess with you on. So I'm just letting you guys understand the meaning of that particular problem, that question. And they're spelling out here that cash receipts are not revenues, which is a very, very good thing. But that's a very typical problem in an accounting textbook. So we'll let you wrestle with it. If you'll roll down here 415, I like to get to the journal entries, usually always. And I want to talk about this problem here because you might not have been exposed to this, in a regular course of your experience here. But if we have accounts payables, guys, people owe us money on the books. Uh, you know, they can sometimes not just be able to pay us, right? Because the company might have some kind of cash flow issue or something. They won't be able to pay us like in a reasonable amount of time as we would expect. So usually people, have an accounts receivable, they expect to get paid at the end of the month or at least by the 15th of the next month. And so there's usually no interest attached to an accounts receivable. So what companies will do that do business with other companies is they will very often receive or accept, all right, or both, a note in lieu of payment. Okay, and understand that a note is more of a formal document than an account receivable, and a note also has interest that will accrue on it. So very often companies will accept a note for their receivables, but when they do, they have to keep in mind record it as a receivable in a formal setting so we can account for it. So you keep in mind we open accounts in accounting when we need them and we want to account for something a little differently. So what we do is we say, okay, well, this is no longer an accounts receivable. This is a note receivable. And as soon as it goes into a note receivable, so we're just kind of swapping receivables here in this first transaction. But it's a kind of a formal declaration that we now have received a note, and that means that we review that note receivable account at the end of every accounting period. And if you'll notice here in B, this is the end of the accounting period. And at the end of the accounting period, we have some interest revenue that we need to record. Now, we're not receiving that interest until that note comes due, like in March of the next year. But at 9 months into it, we've got some interest here, 9 months worth. And you'll see 18,000 times 15% times 9 out of 12 gives you $2,025. That is the interest revenue you need to record. Well, are you receiving this revenue right now? No. So you have to record an interest receivable in relation to this particular note at the end of the year. Now, take particular notice of when we actually collect the note with the interest. And you'll see here that when we get the cash here for the note, we've received, like this company promised to pay us. So a year later, they're going to have to. So when they do, we collect the cash plus all the interest for the entire 12 months. And we have to go ahead and then credit the note receivable that we put on the books, and we have to now remove because it's been paid, right? But then notice this, we also have to take away that interest receivable because it's no longer receivable. We've actually received it. So we have to eliminate that receivable as well. And then we have 3 months worth of interest that is no longer right here. That 3 months worth of interest has to be recorded as revenue because we haven't done that yet. So we do that at whenever the amount is paid, we go ahead and record the revenue in the next accounting period for those months of interest that are from the present accounting period. And because we've already, keep in mind up here, recorded revenue for 9 months, and then we're recording revenue here for 3 months. So that takes care of the full 12 months that this note is outstanding.